Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to do Twitter again. We've been hitting up the Twitter a lot. We're going to see what's going on in the Twitter space for financial stuff out there. I usually talk about commodities or things that are commodities related, or the stock market and interest rates, inflation, deflation, all of those things. If you need any help with anything, I'll say stock market related or financial related, check out finding-value.com. We do have a platinum question and answer session coming up Saturday at 7 a.m. Mountain Standard Time. We'll see you there if you want to join. So let's dive in. I'll give you my financial opinions around it. And again, if you want to follow me, it's finding_finance. We hit 8,600 followers. Cool. So what do we got out there? It says OPEC is worried about a recession too. OPEC, in its economic commentary, the rapid rises in interest rates and global debt levels could cause significant negative spillover effects and may negatively impact global growth. So it looks like OPEC is also getting on board with what could potentially be a recession. Now, I also think that OPEC will defend certain price levels of oil. They're going to cut back production. We're probably pretty close to that point if we were to go and dip into the 60s. I think they're going to cut back production. We have seen builds on some of the inventory levels, and we're going to get, again, an inventory reading tomorrow released. And it looks like we've got, from what I've seen, and we'll go over it here soon, a little bit of draws, not on oil, but on gasoline and products. And I'll show that in a little bit. Michael Burry says, this crisis could resolve very quickly. I'm not seeing true danger here. And I would agree with that. A lot of people, they were panicking. They fear. They get on Twitter. They get on YouTube. And then they try to reel in all the views from the fear-mongering. And they'll also target things that are in the news that people are searching for. So that's kind of, if you want to see a true, in my opinion, a solid YouTube channel, they're not chasing the trends. If they're chasing the trends, they're just doing it for views. They're trying to make money. The big channels do that. There's quite a few big channels that do that. I'm not as keen to do that. So, I like talking about the markets. I like the analysis behind it. I like the technical analysis and all that stuff. I guess I'm not really trying to get like a billion views, trying to do like the trend following stuff. Here's Amir Adnani. He's the CEO of Energy. What was that? Energy. It's UEC. I know things by ticker symbols. I can't even remember the name of the company. It says the annual energy outlook from BP presents 3 scenarios for the future, all of which show nuclear power thriving amid the accelerated move towards clean energy adoption. I agree. I think nuclear is going to be adopted quite rapidly in copious amounts, and uranium prices will have to go up when that happens. Here's Peter Sutherland. He says, today's oil move lower was all about rates, not oil or macro per se. High frequency got smoked on their 2-year note shorts, stopped out in mass, and forced to exit inflation hedges like crude. This is technical rather than fundamental, and net lower rates will buoy crude. I agree with lower rates, but I don't know if we're going to get lower rates, guys. We're at a crossroad here, and it's getting harder and harder to read. Technical analysis-wise, I think rates could go up more. I think the dollar could go up more. Could we get a washout sell-off in crude oil? It's possible. I mean, anything's possible in the short term, guys. We saw that fear come through. It was obviously good for gold. The question is, how sustainable is all this? Are we going to get lower rates? Is gold going to rocket higher and stay higher? Or are we going to get a pullback in gold? Rates go higher for a while, and we get a better buying opportunity. I don't know. We'll have to wait and see. Is the fundamentals and the macro with China and all that, with increased demand from China, going to overpower recession fears and drive oil higher? At this time in shoulder season, I don't think so. So I think we'll probably stay low here, and we might have a little bit of a washout sale, scare everybody out of their positions, and then move higher after that. But that also depends on credit expansion. Are we going to have the real estate market driving that credit expansion still? Are they going to continue to increase interest rates, kill that credit expansion, and force us into a recession or something like that? Those are all possible outcomes. And they're outcomes that are determined by the Federal Reserve to some extent and the market interacting with each other. So we'll see what happens in that and how this all plays out. It says the worst compounding mistake is selling near a cycle bottom when fear is off the charts. So it says, Charlie Munger, you never want to be emotionally in a position where you pull the rug out from under yourself. You don't want to let your own fears, emotions to cause you to sell at the wrong time. And if we look here, we've got fear and greed index, and we're at extreme fear as a measurement right now. Lynn Alden, she's got a little thread here. I'm just going to go over it. It says, in early 2021, Powell said that it's unlikely that the recent surge in broad money supply would cause high price inflation, and that we have to unlearn the importance of monetary aggregates. She says he did, however, say he can't be sure, and said the Fed had the tools to combat inflation if it should arise. Similarly to how Powell underestimated the importance of money supply growth to the upside, he may be doing so to the downside. Rapidly drawing down the monetary base of the country does tend to come with some messes along the way. This is the monetary base, and we get repo spikes and some bank runs as your monetary base contracts. And what that means is you've got less actual, like the physical base one money supply going lower, which is your reserves in some of these banks. Here's the $2 trillion question. How undervalued is the commodity space? It says right now, Apple is valued at $2 trillion. It's hard to put numbers that big into perspective, but for $2 trillion, you could buy every single one of the top 100 mining companies in the world. Not just a few shares, mind you. I'm talking about the entire company, 100 of them, most of which are profitable, and many of which boast the largest and best deposits of real, hold-in-your-hand hard assets in the world. So basically, Apple is bigger than the entire mining industry. Think about that for a second. Seems a little bit weird and backwards to me. And those times, I think, will change. Now, I want to talk about Market Sniper. He has some pretty good calls a lot of the time. And he says, after our bear call on natural gas, we've been bearish energies for a couple of weeks regarding uranium and oil. We've been short for 2 days personally on WTI. The WTI to DXY is our best chart and reason for a 40+% correction in oil. So what he's posting here is potentially a shoulder that could potentially be playing out on a logarithmic thing. I don't know if we'll get a 40% decline. There could be a washout where this washes out for a little, down maybe $10, maybe 20 at best, but that's still not 40%. But there could be a washout, and I do take other people's opinions. He made a pretty compelling case in a video that he had done where oil could go lower based off of this pattern here. So perhaps it could go down, perhaps it doesn't go down. Now, if we hit the 60s, I'm pretty sure that OPEC's going to cut production. And I don't think that will be down there for forever or for a very long time. So what I'm doing is I'm balancing how much money should I keep on the sidelines to buy a potential pullback if we get one? Or do I cost average in slowly? That could be another strategy. So I think what's more important is the strategies that you hold versus trying to time the market perfectly. How does that strategy work if we were to get a pullback? What are the best companies? Have you identified those best companies? Do you have strategies around them? Do you have portfolio position sizes that you're comfortable with? And are you comfortable adding to them if they were to go down? Can you handle that kind of volatility? If I overlay last bull market and I've done this before over this pattern here, it does say that we could potentially have a washout selling pressure move that extends down some degree. That would match last bull market's beginning in the 2000, 2001, 2002 era. It's kind of that pullback there. And it's very well possible we could get a washout in it. So I do want to bring that up to everyone. Now here's Tavi. He says, recent developments caused the U.S. Treasury cash balance to be drawn by over 135 billion just in the last 3 days, the largest 3-day decline in 1.5 years. The government cash balance is running low, and this source of liquidity is drying up. The Fed might need to step in soon. And this is the U.S. Treasury cash balance, and it's just rocketing lower. He does think it may be a little bit lower than this. One thing that you do want to notice here is some of these patterns. I've seen these patterns before. It's kind of, they almost play out over and over and over. This is kind of a washout sale, perhaps, like a washout selling pressure. This is a washout on cash balance. But yeah, a lot of the times they come close to the bottom of where they bottom. So we might come real close to the bottom here, and maybe something happens. Maybe the Fed reliquefies something. I don't know. I'm kind of, I don't want to get in the prediction game because everybody says, oh, your prediction's wrong or whatever. Guys, it's not about predictions. It's about making money. It's about finding the most undervalued assets and just sitting in them. And if we're in a wave 2, wave 3 should be coming soon at some point here. It's not about catching every single top and every single bottom, because I don't think that's possible. It's about making money in a way that is reliable and with a high probability of success. But that's what I'll add there. We've got Peter Schiff here. He says, just because I think he means the Fed, the consumer price index wasn't hotter than expected doesn't mean the Fed is getting closer to its 2% inflation target. Despite all the rate hikes, year-over-year CPI still rose 6% and core 5.5%. Since the Fed is basically done hiking, the most likely direction for CPI from here is up. At least that's his opinion. We've got Grady. Grady's saying, to play the market successfully, one needs the right tools and mindset. Cannot trade a bull with a bearish mindset and vice versa. At trend reversals, one changes mindset. If not, one becomes a victim of wall of worry, whipsawing, FOMO, buying near tops, selling near bottoms. I completely agree with that. My mindset is a bull market. Now, everyone that may not have looked at this data as deeply, or the technical charts, or whatever you want to look at, they may think that because the price is going down, that super cycle is not going to happen. That the technicals look bad in the short term, so therefore the long term is also negated. I don't believe in that. I believe that we are in a super cycle. I believe that we have the technical analysis on a big long-term picture view that is going to be riding higher in a big picture view. And in the short term, we are doing a wave 2 pullback, which eventually be followed by wave 3, which is the largest, biggest wave in commodities. The exact timing, I don't know. A lot of people, we try to predict it. We try to look at patterns. We try to do all this stuff. That's about all the best you can do. That's all you can do. But the herd's going to do what the herd's going to do, and whatever market conditions are out there, the herd's going to react to those market conditions. Whether that's inflation, whether that's the fear of recession, the fear of a housing market crash, the fear of whatever they are making up in their heads. Martin says, so many are missing the big picture. This is conventional crude oil production from 1920. Actually, I'll go back to where we were. This is conventional crude oil production from 1920 to 2022. That has peaked. We are way down there for conventional crude oil. Now, I know the shale oil has made up quite a bit of that slack in the world. Shale oil might be peaking too. And what I do is I look out there and I say, okay, oil is going to have a problem. Now, I'm not predicting that oil is not going to have a problem in the short term. It very well might. But it's going to have a problem irrespective, I think, of anything that humans do, any technological advances, any new finds that we have, I don't think we've got another 10 years of growth. But that's my take. So it's probably T minus 10 years. And if you were to look at just the decline rates, if you take an 8% decline rate on a worldwide production basis, and then remember, shales are a lot steeper than that, and a lot of these, heavy oil shale plays are steeper than that. But let's just take 8% for worldwide. That means every single year we're declining roughly 8 million barrels every year. And we have to find 8 million barrels of oil, new oil, every single year to stay flat. Saudi Arabia is around the 10 million per barrel mark, somewhere around there. America's around 11, I think, 11 something. We're basically the largest producers, and we need to find every single year pretty close to the largest producers in the world to grow oil production. I don't think we can do that for the next 10, 15 years. I don't think we've got that much out there, but that's my take on it. And I think that eventually we're going to hit peak oil at some point here in the next 10 years. And it's going to put insane amounts of pressures in the system that we've never seen before. So I think, physical metals and oil and energy are probably some of the best bets on a long-term basis. And I'm willing to bet Buffett has a very similar viewpoint. And that's why he's piling into a lot of these other oil companies. This is John Hinster. This is his view or my version of the uranium. And he just put it on this, basically that low there. And he just tapped these guys in. And maybe we're still within this gigantic pattern. So yeah, that could very well be a chart that is more valid than, say, running across these guys through here. It says, my biggest investment mistakes were not buying enough of the ones that were really good. And I think a lot of people say that. It's tough to know exactly which ones are going to be the best. But you really want to pile into them in a low risk, high reward opportunity when everything's aligned. That's when you want to go big. I went pretty big on oil at the bottom of 2020, luckily so. I've been riding it still. And I'm not trading in and out. I'm just going to ride the entire bull market. And I think we're still in a bull market of oil. We're just in a softness of it. And I have been and will be adding along the way to my favorite companies. Here is Grady. He says, posted this ratio chart this autumn at a blue back test. As gold made the shakeout below big supports, precious metals looked ready to outperform the commodities, heavy Canadian TSX stock exchange once again. And, not a lot of people like the mining companies, including myself. Like, I'm always back and forth with them. But, I can definitely jump on the royalty train. That's pretty easy for me. Diversified, cash flow, lower risk. And I think they track precious metals pretty well. But they are cheap. Guys, they are cheap. And when we break some of these downtrend lines, and right now, this does look like it could potentially go higher for GDX in relationship to TSX. We could see some crazy stuff happen in gold and silver mining companies or the royalty companies, however which way you want to play it. So yeah, that looks good. We've got this here. This is from SRS Rocket Report. It says Peru's silver production January 2023 falls 20%. More bad news out of Peru versus silver production declined 20% versus Jan 2022 and 26% versus December 2022. Peru's silver production declined 51 metric tons versus the same period last year, about 20%. That's crazy. Mike Simonson says, just amazing how few distressed properties there are still. So this is delinquencies, foreclosures, and REO. That's real estate owned properties. And look how low we are right now. Now, I know this doesn't mean that it can't go higher, but I mean, maybe we've got a good 3-4 years left in this thing. What that means then is that the banking system isn't going to have a deleveraging or credit event. They can get losses, they can kind of run out of reserves, but it's not going to be this credit destruction event. And I don't think we've got the inventories of real estate out there. I was just looking at some more data on real estate for February. And guys, I mean, inventories are up a little bit, but they're still incredibly low, like 3 months-ish, and they're dropping still. These past few months, they've been dropping. So the housing market's been strong. It says by now, it's no surprise that available inventory of homes for sale keeps falling. 412,000 single-family homes in the market now, down 1.5%. And that's what I meant by this year's inventory still falling. So I'm going to end it there, but that's what I've got right now, kind of for information. And, I'm not afraid at all, guys. I don't know what it is. I don't know if I just can ride through it, whatever. But I'm really comfortable with my positions. I'm heavily oil. Don't get me wrong. I've got a lot in oil. I've got a lot in precious metals. I've got a lot in, diversified mining companies and royalty companies and stuff. And I don't know. I just don't feel like panicked or fearful. There's a lot of people that are very fearful and very panicked. And I don't know what it is. Maybe it's because I've ridden up the big bull market in oil, or I should say the beginning of the bull market. There was some pretty big volatility there, and maybe it just shook it all out of me. Remember, I've never seen the beginning of a commodity bull market. I was too young. I wasn't paying attention to stocks back then. I did see the middle to back end of that commodity bull market, and there was some crazy stuff going on. It looked really fun and awesome. I saw a lot of really big moves, and that has stuck with me the entire time. I don't think we're there yet. And I think once we get past this wave 2, you'll understand what I mean by wave 3. I'll just say that. So I've got my favorite companies. I'll add into them. If we get weakness in the oil and natural gas, or I should say oil and natural gas stocks, which is very, it's very possible. I'm going to be looking, and I'll still be looking to add to my favorite royalty companies too. So I'll talk about that in the midweek update tomorrow. I'll talk about the ones that are looking pretty good and what I might be thinking around it. All right, guys, that's what I've got for today. We'll catch you next time. This is Finding Value.